Welcome to an information event, we call it, about buying a legal practice and buying into a partnership. It's primarily about buying into a practice. Most of the information is about buying into a practice. So I'm Keith O'Malley, and I'm here to welcome you and to talk through who's going to speak and what we're going to do. Shane Farrell, my colleague who works in practice support, is going to speak next. He's got three different items to talk about. Then Conor McLaughlin is going to talk about his own personal experience of purchasing a practice. We're then moving Anne Neary from the last slot up to the third slot, and Anne, everybody I'm sure in the room knows Anne, and she's going to talk about the practicalities of identifying and an acquisition target and negotiating and all of that. We then have a break, and after the break, Gary Troy from Bank of Ireland is going to talk about financing options, and then Hilary Hayden from Hayden Chartered Accountants is going to talk about due diligence.
Good afternoon. I'm Shane Farrell, practice support person for Support Services Law Society. I've been in touch with most of you guys before today. I just want to touch on three areas in this presentation. So, about the practicalities of what you can buy within a practice or within a partnership, the succeeding practice rule, and relevant regulatory responsibilities. So what you can buy. What you can buy when buying a practice, ultimately that's anything or any combination of what you want. Most common would be the business itself, but you can also look at business and premises. Business premises can be sold as one, but we would advise against that just due to the way that the banks operate and the current lending policies. There are better options. You could look at the business less the staff. So there's pros and cons to this. Pros and cons to having staff with a lot of experience, knowing the clients, knowing the files, but obviously there's financial obligations as well. Business less debtors, so work in progress. There may be a discrepancy on value of the debts, so it's usually easier for the original solicitor to actually collect these debts. They will be more successful at that, and it works out less expensive for you yourself as the purchaser. Work in progress. You can look at any combination of files. You can pay up front, you can pay once the fees come in. An example of this would be, say, medical negligence files for the firm. And then a client account, something like debt collection with a large financial institution. What you can buy when buying into a partnership. So there's lots of arrangements which can be made here. You can look at the equal equity partner, so that's yourself and existing partners. Most common, though, would be the other equity partner, where the fees are split. So this kind of works out as a eat what you kill sort of scenario. Then there's also the option of a phased purchase arrangement, where you're looking at a percentage increase over time. So, for an example, again, 20% year on year as you're growing into it. A salaried partner or otherwise known as a junior partner. There's no equity in this. You need to be careful. You can be held jointly or severally liable for the debts with this particular option. Partner by holding out, similar enough. You also need to be careful here if an owner actually holds you out as a partner when you're not actually at that level. Again, you can be held jointly and severally liable for the debts there. So just another thing to look out for when partnership. The succeeding practice rule. Now, the Law Society does not and cannot provide any legal advice on whether you are a succeeding practice or not. You would need to talk to your insurance broker about that side of it. It's well laid out in the booklet that we've provided after the slides for Simon Traynor. So near the first part of the book. Definitions about ceasing firms, regulation amendments, multiple succeeding practices. So just looking at that. If you're held out as being a successor, the succeeding rule will apply. Half or more of the partners the same. Same sole practitioner. So if you're a sole practitioner, you close the business, you take a break for a while, you return, you open again, the succeeding practice rule still applies for you there. A sole practitioner who was a partner, or vice versa, a sole practitioner who joins a partnership, again, the succeeding rule applies. And a successor firm assumes responsibility of the staff or creditors, etc. As I said, it's well laid out in the book. The Law Society can't provide any legal advice on that side of things. You would need to speak to have a look through the booklet and have a chat with your insurance broker about that. Now, looking at cessation matters. Now, a cessation is necessary when an old practice closes down and a new one must emerge. So there's at least one cessation in each of these four areas. So when you're selling a practice, it's a cessation. Merging a practice, passing on a practice, or changing a firm structure, say from a sole practitioner to a partnership or vice versa. Succession is necessary. Now, when cessation occurs, these are the responsibilities to the Law Society. So, cessation notification and application must be sent to the Law Society. The Law Society needs information of where all the files are, wills, current files, closed files. The Law Society also needs the home correspondence address of the person that is ceasing the business. The PII run-off cover of succeeding practice, and the closing accounts report, which I'll touch on a wee bit later in the presentation. So, client contact. Client contact is necessary if you're taking over the firm. It's important to remember who owns the actual files, and that's the client themselves, not the solicitors. So a vendor needs to advise clients on what is happening in advance. You need to provide the client with an option to nominate a new solicitor or to take possession of the files themselves. And if a client is remaining on, you need to request fresh authorization from them to carry on their business. Regulation matters. So sale transfer notifications are necessary to involve the Law Society. You need to notify them of the effective date. You need to clarify what files are being transferred, some to a succeeding practice, others elsewhere, storage, again, when you're looking at current, closed and wills. Details if the files have already been distributed and where to. Confirmation that clients' monies are transferred to a new firm, and confirmation about succeeding. The succeeding practice arrangements are in place and that they're being adhered to. So, release of undertakings. The release of undertakings need to be organised in advance of the purchase. So note each outstanding undertaking for the Law Society. The purchaser solicitor writes to each recipient and the substitutes. Now, it's unusual, but if the substitute is not appropriate, you need to make another arrangement so that the client is not put out, compromised, or basically in a worse situation than they were prior. Regulation matters. Purchasing firm notices to the Law Society. These are the notices that notices to the Law Society from the purchasing firm. So notice of proposed merger purchase goes to the registration department. Any firm name change to the registration department. Again, any change in firm address or contact details. And notice of the status of any solicitors that are joining the firm. So what level, if there's a partner or not a partner or a solicitor. The closing accountant's report, which I touched on earlier, this must be within 2 months of closing down. The report itself must be the same format as the annual report. If you're not going to make that 2-month strict deadline, you must notify the Law Society as soon as possible. The date the day client balances became nil. So not the date that the premises or the business or anything like that was sold, but when the actual client balances became zero. Everything there is in the notebook. Have a look at the succeeding practice rule, which is covered extensively. And I'm going to pass you on to Conor.
Hello, everybody, and thank you for coming, despite the inclement weather. So, in essence, I took over a firm about 2 months ago. I actually came to talk to Keith on the 6th of August of last year it was, and I bought the firm on the 30th of November, so about a 15-week turnaround. So I suppose it shows you how quick it can all happen when things get going. I just when I talked to Shane about today's event, I just put down a couple of bullet points about the main things that I would think would be beneficial. And when I was preparing this, I prepared it in a sort of perfect scenario. So let's say you had 18 months to prepare, or you had an uncle who had a solicitor's firm and he was just preparing for you. It's really a sort of perfect type situation. You know, in reality, things don't happen like that, and there's no perfect time to start a business, no perfect time to start a solicitor's firm. But I've put as the first heading there personal, which I know some people might think, you know, that's more for a life coach or something like that. But if you don't get those things right, those are the things that could trip you up into the future. I mean, you can imagine, you know, the day before a huge court case or any problems that you might run into, you really want your ducks in a row beforehand. So if there are outstanding, nagging issues, perhaps, you know, it's a good time to get those rectified and to make sure that you can concentrate, because it's, I mean, for the first 18 months, 2 years, you're going to be in a position where you're dedicating 7 days a week to it, and you really need to be in the correct headspace, I suppose. So I'll not dwell on that too much. You can figure it out, I suppose. The next heading there is preparations, and I've written down reasons why. And I suppose the reasons why could be anything at all. It could be that you're working very hard and you think that you're working a bit too hard for the salary that you're getting, and that when you work this hard, you should really be working for yourself. It could be that you have certain financial goals. Perhaps you have certain goals to retire at a certain age, or to buy that gîte in France, or whatever your particular aim might be. And while they might be obvious to you to now, it's good to write them down, because I can tell you in the future, some rainy Tuesday evening when you're working till 11 or 12 o'clock, you're going to be asking yourself, why am I doing this? And it's good to have something to go back to and say, hold on a minute, this is the reason I changed, this is the reason I took the leap, I made the decision, and there is sense to this. So that's perhaps why I put down reasons why. The next bit I put down was put yourself in the position of a business owner. So most of you are working for somebody at the moment, and you're all busy. The files land on your desk, you do what you're supposed to do, and you move on. But I suppose what I mean by put yourself in the position of a business owner is that file lands on your desk, and you start to ask the question, well, where did it come from? There had to be some kind of marketing here. Was that a client contact? Was that a real estate agent? Who was the contact? How did that happen to land on my desk? And then work through the situation. Some of the things you will know already, the AML process, and right on to the administration and the account side, the various postings, and how the file closes off. Some of you will be very aware of that, depending on where you work. Some of you won't. But it's really just to put yourself in that position, test yourself. Where is the work coming from? How has it been processed? And work yourself through the stages. You don't want to be in a position where you're running your own firm and you say, well, I never really did that before. You know, the work just came to me and that was it. It isn't the way it works. You need to know from A to Z what happens. So I would just say put yourself in the position of that business owner and really test yourself at every level. You have a dry run while you're working for somebody else. You know, you test yourself on every level, whether it's AML, GDPR. Have a look around the office. What are the types of things that a business owner looks at? They look at everything. They look at the fire extinguishers. They look at health and safety. They look at managing staff. So maybe push yourself a little bit. Try and get involved in that and prepare yourself for your move. The next thing in terms of regulations, again, you're probably familiar with a lot of these, but you'll need to get more familiar, I suppose, is the key. And any Solicitors Acts relating to accounts or advertising, I would certainly read them, find out the answers to any questions you have. And again, you can use where you are to, if you don't get involved in the postings or the accounts end, then maybe push yourself to ask some questions and just find out how it all fits together. So again, you're basically placing yourself in a dry run for the future. If you have any questions, by the way, you're free to stop me. Another thing, I suppose, is the financial supports. Now, the local enterprise office, they have 3 different types of grants: feasibility, expansion, and I think there's another one, but they're not open to solicitors or accountants. But they do have a voucher trading system for a website where they will support you up to 50% of €5,000 towards a website, which is certainly helpful. There's some information on their website. You have to attend one of their information days, and then you sign up. And they'll ask, there's a fairly lengthy application form, but stick with it. I definitely think it's worth it. And I mean, that's your shop front. You know, you can be based in the smallest town in Ireland, but if you have that website, that shop front, you know, you can get business from anywhere, and that's key. You can have the quality of life in maybe the countryside in Ireland, but you're getting the quality work in because you have a good website. So definitely look into that. There's a scheme there called First Steps, and First Steps relates to young unemployed people between 18 and 24, and they're basically supports to take these people on. It's up to you how you would see their role in the firm, but it's something that is open to you. And then I have financing. I think it's probably going to be touched today, financing of practice search and insurance. So, for example, around this time of year, it's a particularly expensive time of year. You know, you look at the weather outside, the oil bill goes up, perhaps you have rates, you have practice and certificates, you have insurance, and all that is, you're lumbered with all of it around November to February. So any financing you can get, definitely look into it. Try and spread your bills at the start so you're not getting pummeled too much in the wintertime. Also, actually, somebody told me today that they noticed, they were in business for a long time, and they noticed in the wintertime that staff output level in the winter goes down a lot, the mood is down and whatnot, and that's exactly the time that you need the financing. So the next one is upskilling, and I suppose that goes back to my earlier point of putting yourself in the position of a business owner. So you can't be an expert on everything, but certainly, you know, as a business owner, you need to be a bit of an all-rounder. When somebody asks you about IT, about your server, where is your information held and so on, you need to be able to respond. And again, I'd go back to your current positions and test yourself. What do you know about the position you're in now? Accounting, I mentioned earlier, and then legal. So for example, if you're a specialist in litigation or PI, and you know when you take on a practice that you're going to have probate or conveyancing to survive, you need those files, then there are master classes here, and I'd certainly look into them so that you have an idea. Even if you position yourself that, okay, I'm going to be the litigation guy in the office, I'll leave somebody else to do the conveyancing. Conveyancing and probate are obviously fraught. You need to be looking over the shoulder. You need to be able to survey files appropriately, and I definitely would consider upskilling if that's going to form part of your practice. Marketing, there's a very useful course here, again, in marketing, and I think there's some online courses. Some people are, I suppose, more traditional. They like to meet someone for maybe a coffee, give them their business card, and try and work out a relationship like that. Some people are more targeted. They're talking to builders or whatever the case may be. I would maybe do whatever's comfortable, whatever you feel comfortable with. So moving on, I suppose, to the website. The website is your shop front, and it gives you enormous exposure. So I think it's definitely something that's worthwhile. Just to give you an idea, my website, when I was preparing myself, to give you an idea of the time that it takes, it's a good website, I hope, but to give you an idea of the time spent, I probably spent 12 hours a day for maybe 14 days working on the website alone. So in terms of preparation, you need to be thinking about the time and all of the things involved. So just to give you an idea. Obviously, sort of going back again to the second slide, putting yourself in the position of the business owner, your templates, where you are at the moment, you have those templates, those handy letters to the county council or whatever the case may be that you call on all the time. Are they going to be there when you're up and running? Those are the things that save you time. So again, you need to prepare those and make sure that you're ready for any matters that come through the door. Policies and procedures. So I think this is probably one of the biggest challenges for one-woman shows or one-man shows. You have your GDPR, you have your health and safety, you have your staff handbooks. You're not going to have the time to do them when you're trying to meet your bills and you're trying to do your marketing and you're looking at your website and you're managing staff. So again, in a perfect situation when you know when you're going to become the owner of a new firm, it's good to get these things in place and have an idea of what's required. I suppose some other ways of maybe marketing, your Q-mark or your Lexcel is the UK version. It's a quality mark for legal services. Case management system. So again, you have various systems out there. Some you might be comfortable with from your own experience. But I definitely have a look at others. A lot of these case management systems, they'll send you maybe a sort of virtual examples of how they work and find out which one works for you. Definitely an accounting and case management system combined, I think, is the best idea, where you're not sifting through different systems. Again, it's down to personal choice. Some people love Documatics, other people like Courtbase or whatever the situation may be. And then the last one I have is awards. I think this is probably something a lot of people don't think about. There are a lot of awards out there in every county, whether it's business awards, awards for websites, Irish Legal Firms Awards or whatever. Have a look at them and see what's open, and certainly consider them. I mean, it's a great way of advertising your business, a bit like the Q-mark or Lexcel.
Good afternoon, everybody. Thank you very much to Shane and to Keith for organising this event, which I think is very, very helpful for people who are interested or thinking of either buying a law firm or buying into a partnership. I have been involved in this area for the last 15 years, acting and advising solicitors and law firms in quite a number of areas. But one of the areas that I have been active in for a number of years is people coming along and having an interest in buying a law firm or buying into a partnership. Now, those two things are very, very separate. So I'm going to concentrate on buying into a law firm and buying into a partnership as an outsider, rather than somebody who's coming up through a law firm and who's invited to become an equity partner, and perhaps there might be some capital payment for that. I think that that's a completely different issue. So I think really what we're looking at is either people who are already in business, who already have a law firm and who are thinking of acquiring another one, or somebody who feels that they would like to move into this area, become a business owner, buy a law firm, and that's their first experience of business. I thought Conor's presentation was very, very interesting because, as he has explained to you, he has just acquired a law firm. And when I was talking to him earlier, he explained to me that what he's doing is he's creating a template law firm. And I found that to be a very, very encouraging sign, because for many, many years running a law firm has been a very ad hoc business. And it's really only in the last 10, maybe 12 years, I'd say 10 years, that we've started looking at law firms as business propositions and putting a structure on law firms. And really up to about 2008, law firms were very much run on an individual basis, as a lifestyle business, and there would have been quite an absence of policies and processes and procedures, very little information on IT systems, and not a great understanding of financials. Now, what has changed over that period, I think, is an understanding and an appreciation that processes and systems are there to structure a firm. So the days, particularly a Monday morning when you go into the office and the last thing you want to do is engage with any type of work, let alone your financial or billing or collecting or any of these disciplines, business disciplines. In the past, people were much more inclined just simply not to do them at all and concentrate on what they were good at, which is basically meeting and greeting clients and running their files. and not looking at anything else. So this particular topic gives us the opportunity to have a look a little bit more forensically into the whole process of acquiring or buying a law firm or a business. You have a number of options. Obviously, you can start up, and I have advised many startups over the past few years. I'd say fewer in the last number of years, because people now appreciate how difficult it is to start a law firm from scratch, and it can take many, many years to build up a reasonable fee income. You can buy the practice of a sole practitioner, and there's always opportunities in that area, because as you know, the older members of the profession start hitting 60, they are really seriously thinking about how they get out of their law firm and what life is going to look like for them as a retired solicitor. So there are a number of those practices that are available throughout the country. Much more difficult to sell the practice of a sole practitioner outside Dublin than it is inside Dublin. Buying a partnership, you can buy a partnership interest in a law firm as an outsider. Doesn't happen very much. It's much more common that people will buy out the existing partners and buy over the whole business. The deferred purchase is where a firm might bring in a younger solicitor with a view to selling the practice or handing over the practice over a number of years. And that is structured more as a contract of employment. And in the contract, then you can set down the understanding, what the parties envisage in this relationship and where this relationship is actually going. You can buy a large firm with one or two other people. You can, and then the structure, the way you do things, is you can either buy a firm as a succeeding practice, in which case you go in and you take over the liabilities of that firm from really going back to the time it's set up. And that, no matter how much due diligence you do, is a scary proposition, because it's bad enough when you're running your own law firm and you really don't know what mistakes have you made over the past 6 years, and you know what letter is going to hit your desk with a claim coming in from a client. That's bad enough when you're familiar with the files, but when you're actually going in to acquire particularly an older style law firm as a succeeding practice, there is an element of risk there that no amount of due process is really going to eliminate. And then another way of acquiring a law firm is that the people who are selling the law firm go into run off themselves, in which case the Law Society has, over the last number of years, introduced a very attractive system, which is that any solicitor who wants to retire is entitled to go into this run-off fund at no cost. And that, I think, has been one of the single biggest opportunities and for people to get out of their law practice and retire, and then for other people to come in and buy. In which case, you don't buy the goodwill of the firm, you're just really buying the files. So the person then who goes and retires, avails of run-off, can and is permitted to go back as a consultant for a limited time, and that's a matter of negotiation between the parties. And then the acquiring firm essentially acquires files on whatever commercial basis they agree. So they are all the issues. I think that Conor has covered quite well all the elements that you have to be thinking about when you acquire a law firm. And in my experience, almost everything that he has said is outside the comfort zone of most practicing solicitors. So if I go down through the list, he was talking about the financials. Now, many partners of law firms throughout the country really dislike the financial aspects of running a law firm. And one of the first questions that I would normally ask people if they come to me for whatever questions they have is, what is your fee turnover in the past year, and what were your expenses, what were your profits. And I'm just very interested to see whether or not that solicitor has a grasp of those three most essential figures. And I would say 60%, 70% of solicitors that I'm talking to are unable to answer that. Like, how much money came into the firm in the previous year? Now, that tells me an awful lot about the solicitor, because then I know that we're very unlikely to have hourly rates, we're very unlikely to have time recording, we're very unlikely to have case management. So not understanding the basic finances of your law firm will tell me that that person is running the firm more as a lifestyle business rather than as a business person who really understands that it's the financial disciplines and the financial information that will create a successful business. Marketing and business development, again, this is not an area of practice that most solicitors enjoy. Some solicitors are very, very personable, and they develop very, very strong interpersonal relationships, and they can turn out to be very powerful rainmakers. But if you want to try and systemise that, or if you want to try and draw other solicitors into the marketing and the business development, that can be much, much more difficult if they don't personally like it. But nonetheless, it is a very important part of acquiring a business. Managing staff and HR, basically not something solicitors really like doing. And although there has been improvement over the last number of years, I have found that solicitors don't like to draft contracts of employment for their staff. That just doesn't appear to be something that they like to do. Understanding of regulation and statutory obligations, once again, is getting much, much better, because I think that we have a natural affinity towards regulations because we understand them better, because that is our area. But when it comes to processes and systems, so how do you actually run a file in the most effective way, the most cost-effective way, with minimum amount of typing, using the maximum numbers of templates. This is another skill that is required of a solicitor who's buying a law firm, which is not a natural skill that most solicitors have. The drafting of policies and procedures, well, at least now we've got the Institute of Legal Research and Standards and the Q standard, so that you can actually, for a very small amount of money, you can buy the entire raft of all the systems that you need, and they're given to you as templates. And they will also send you in an auditor or a consultant to sit down with you and go through that entire process. And I think that that's very helpful and very, very good value. That was an institute that I founded a number of years ago and have subsequently sold, so I don't have any interest in it. But I do believe that when you're buying a law firm, if that firm doesn't already have a quality standard, this is something that you could look at as a priority and get in the auditors and get in the solicitors, who will give you a remarkable amount of help. Now, getting into more the specifics. So let's say that you have decided that you're quite happy to take on this additional workload in addition to your files and fee earning. And you say, this is definitely the way I want to go, and I have a good plan, I know how to do it, and my bank is going to back me. So that's the situation where we're moving into now. So the question now is, how do you determine if this is the law firm that you want to acquire, that this is actually worth the investment of money and time and effort and energy? The first thing you have to do is you have to look at certain records of the firm. So there's certain documentation that you're going to be looking for. So if I just bring us on here to this firm here. This is the information that allows me to put an initial assessment on a law firm as to whether or not it's a good proposition. So I look for the last 3 years' audited accounts, and almost invariably the most recent year is going to be management accounts, they won't be audited. I look at the fee income and the breakdown of that fee income. So I'm looking at fee income over a number of years. maybe the last 3 to 4 years, and that tells me a lot about the sustainability of the firm. Then you can have a look and see whether or not there's any other income coming into the law firm that may or may not come with an acquisition. You have a look at the expenses of the firm, and you look through those forensically. So you want to know, are they spending too much on overheads? But what I find when I'm looking at expenses is they're not spending enough. So very often you're going to find that there's no expenditure on IT systems, and software and staff training. So that's one of the areas which to me is completely vital if you're buying into a law firm, because preferably you'd like to buy a firm that's already efficiently processing files. I like to look at the client account balances for the last 3 years, and this again gives me an idea about perhaps the size of the probate practice and the administration of estates, because this is where in general practice you are going to find reasonably large sums of money in the client account. Sadly, of course, in the last number of years we don't have interest on the client account, so interest in general as an additional source of income is no longer worthwhile considering. It will, I'm sure, come back again, but interest used to be a very interesting additional income. Then I start looking at the work that's carried out by the firm. So I start looking at the work in progress. And this is where things come to, very quickly, a grinding halt when you ask the person who's selling a firm for a list of their current files. So you would expect, if the person is interested in selling you the firm, that they would be putting together a proposition for you. And the proposition basically consists of, in the end of the day, the heart of what you're buying are those files. Trying to get a sole practitioner to give you a list of current files is not the easiest thing in the world, but if you persevere, you will get there. Now, on top of that, so as soon as you have your current file list, I like then to throw them all into an Excel spreadsheet, because I like to start playing around with the numbers. Now, this is when you're thinking of buying a law firm, right? So when you have a look at the list of current files, you don't at this stage obviously want to see client names. So it's amazing how often when you get that list, all the client names and their addresses and all their information is there for you. So client confidentiality would tell me I prefer not to see that. I would then like to put valuations on all of those files. So I would like to know, like, how many conveyancing files have I got? Approximately where are they in the life cycle of the file, and what the fee is going to be. Conveyancing, of course, is a very quick life cycle, so they're not going to contribute an awful lot to the work in progress valuations. But if there's a lot of conveyancing there, at least you know that the likelihood of it is that is going to continue. So remember, we've got a spreadsheet, an Excel spreadsheet. We've got our list of files. And right across, there's a few figures that we want. One of the first figure is what's the work in progress valuation, and the next figure you want is, well, what are the expected fees on the completion of the file? So how much money is this file going to bring in when it eventually closes? The next piece of information you want is, when is the file going to close? And then you want to extract out of the work in progress large once-off fees, because those fees, 50,000, 80,000, 120,000, can give you completely the wrong impression of the profitability of a law firm. So I like to strip those out, or I'll put them in a different category, because a lot of law firms, smaller law firms, have these babies that they're feeding, these files that come to fruition just perhaps a few every year, and those files can be responsible for a reasonably large percentage of the fee income. Then I like to identify recurring fees, so recurring fees coming from particularly good clients, and then that tells me how reliant this firm is on a number of larger clients. And then obviously you should categorise all the fees under matter type, and that will tell you what you're buying into also. So that information here is absolutely crucial. So once you have your nice spreadsheet and you have all of these figures do not have to be completely correct. All you're looking for are broad brushstrokes at this stage to try and assess whether or not, if you buy this firm, you are buying a good business proposition. These are the questions then that, when you've done that first exercise, you have to ask. And so you want to identify the number of new instructions in each month of the past year. And again, that's going to give you some sort of an idea as to whether or not this practice is growing and where it is. You will obviously ask the question about client profiles. So who are the clients of this particular firm? And when you're looking at the commercial clients, the company clients, the trade unions, any of those categories of clients, you know that actually a sustained marketing effort in that area is quite likely to produce additional work in that area. Private clients obviously are a lot more difficult because they are inclined to be once-off transactions. You have to ask yourself, has this firm got any niche specialisations? So a general law firm is unlikely to have specialisations. Some of them do some med-neg cases, but they have become so expensive over the last number of years to run that very often even PI firms are not that happy to run medical negligence cases. The niche specialisations, again, will feed into your business development plan, because you should be able to say, look, I do think that there's opportunities here. And the person who's selling the law firm, there's a phrase that everybody to me seems to use about their law firm, which is there's huge untapped potential in this law firm. So everybody, without exception, tells me about the huge untapped potential. That means that the person selling you that firm feels that there has been opportunities over the years that they've let go. So, if only we had spoken to, the trade unions, we could have, we could have got the work from a fellow trade union. And so I completely discount that, because once I start really digging into it, what do you mean by missed opportunities and what do you mean about potential? It's stuff at the back of the solicitor's mind. And so this is something that you have to try and understand yourself. Can you take any of the legal services and grow them? Is there a speciality that you have that you know that you can bring to that? Or is there a trick that solicitor has been missing? Wills cabinets, this is very geographical. Wills cabinets. I don't think I've ever put a value on a wills cabinet. I have been asked to value them for revenue purposes, but it's extremely difficult to put a value on that. But solicitors love their wills cabinets. And the particular solicitor who has spent maybe 30 or 40 years putting together a wills cabinet this is like their child. But when you start going through them then and you start blowing the dust off the wills, it starts getting a little bit depressing, because at that stage you're wondering, well, which one of these wills is actually going to yield fruit and become a probate. So I like to see a wills cabinet because I think, once again, there's untapped potential there, but I just don't place a huge financial value on them. I always ask the question, who are the PI insurers? Because I did a huge amount of work in 2008 to about 2014 in that very area. So I look into who's insuring, how often has the firm been switched, how often do they switch between insurers? So if you're with somebody like Liberty or AIG, the bigger insurers who are a bit more expensive, they have their portfolio of clients, they have their portfolio of law firms, and they do look after their loyal firms better than the people who come for a year and then they know will leave them again. So it's interesting information and it's worthwhile knowing. And of course then that brings you into the whole issue about their claims experience and how much are they being charged, and how much have the insurance premiums varied over the last number of years. Then I like to know who the bankers are, who the accountants are. I'd normally have a chat with the accountant, and the solicitor acquiring the law firm can and should go into the bank and just see what that relationship is like, and is that a relationship that can be fostered and that can grow. You're going to be looking at staff. Staff is a very interesting element of this. I still haven't really worked out, are staff a liability or are they an asset? It's a very, very difficult one. And Conor, sorry to be quoting you all the time, but it was just very interesting hearing your experience. And so when you go into a firm that has been operational, how many years was the firm that you bought over? How many years was it in operation?
It would have been 70 years in the same family, so when somebody new goes in, obviously, even if they're in the same family, they have different ideas and...
Yeah. So, and what about the staff?
Well, the staff, I suppose, like anywhere, they're used to certain policies or certain standards, and I think I was talking to somebody this morning, and a barrister this morning, and he was saying that sometimes even moving the dustbin from one area to another can cause ruction, you know, or car park spaces or whatever. I mean, it depends on where you are. And
so you see what I mean? Can be an asset or can be a liability. So Conor wants to introduce an IT system into the firm, and the question is, how are the staff going to feel about that? Because they've been doing things perfectly well for the last 10 years, and there is no need for all these screens. You know, and these are issues that you really have to think about. Now, if you take on the staff, the person selling you the law firm is rubbing his hands together because, of course, then he doesn't have to make them redundant. So that's what I'm saying to you about the liabilities. And one of the first things I do about staff, just as well we have no staff here in this room, is I ask, how long has that person been there? How much money are they on? And then I stick a figure beside their name, which is not a good figure. That figure is how much redundancy are they entitled to. So that's going to tell you pretty quickly whether or not, you know, you want to take on somebody who's been with this firm for the last 25 years and who's basically been running, you know, everything behind the back of the partners. So get a lot of information about the staff. And before I leave that topic, there are some law firms that you cannot buy without the senior secretary, because there would be literally nothing there. She's the one that's running it. She's the one that the clients know, and let her go, and the clients could well follow her. In relation to the premises, obviously, this is very easy because, you know, it's so obvious. Is it leased or is it owned? If the solicitor selling the law firm owns the premises, they are seeing another lovely second stream of income coming in. So that second stream is going to be in addition to what you pay, what you decide to pay for the firm, and you have to be very careful about the rent that you agree. Now, obviously, in my case, I do get a lot of solicitors coming to me who have bought too quickly, and they haven't really thought these things through, and the fee income wasn't quite what they thought. The rent is over market value, and the expenses are high, and the staff hate them. And this can take a couple of years to work your way through, and it's at this stage that you can avoid those sort of problems. Equipment. The person selling you the law firm always has great equipment, wonderful systems, lovely computers, a great server. And you go in and you have a look and everything's 7 years old, but it works perfectly. Now, there's another thing that you have to think about, because there's going to be a big investment then in IT and very often software. So you have to make a decision about whether you're going to become a successor firm or whether you're going to request that this person go into runoff. If you ask the solicitor to go into runoff, you cannot then buy the goodwill of the practice. Then you're just buying the files. and you have to be very careful. Shane has gone through the rules about succession firms, and I actually think that that was a very good time to do that at the very start of this afternoon, because it's a big, big decision. And if you decide you do not want to be a succeeding practice, then you have to be very careful about the rules and the runoff and how everything ties in together. You will then obviously have to draft a purchase agreement, and I'm not going to go into that in very much detail, because that basically just reflects the agreement and divvies up the files you're taking, the files you're not taking, etc. Now, your bank is going to want a copy of that purchase agreement, and more importantly, your insurer is going to want that, a copy of that agreement. So, looking at other issues, I always feel myself, when I prepare a talk like this, or when I'm talking to somebody, oddly enough, client management, even in my list, always falls to the end. I've no idea why. So I've decided this time I was going to put client management right up to the very top. The older I get and the more experience I acquire in business, the more I realise that business is all about relationships. That's what it all comes down to. You know, the purpose of having your case management system and running your files effectively, it's all down to, you know, having a good relationship and an enduring relationship. So client management is really all about how the client perceives the services that he's receiving from the law firm. So here's an interesting thought for you. You could ask permission, if once you're quite far into the process, to talk to a sample of clients. Wouldn't that be very interesting? And just say to the client, you know, you've been with this firm the last 15 years. Tell me about your experience and tell me what you think. And listen to the recipient of the services, because you're going to learn an awful lot. And that ties in with how you're going to deliver your legal services. Client expectations. So these are all issues in relation to client management, and I'm not going to go into it in too much detail because that is an entire topic by itself. Cash flow projections. We were talking earlier about the fee income and the fee income coming in. Now, you're acquiring a law firm. The question you want to know in the first year is, are you going to break even? Are you going to have to put money into the firm? And if so, how much money are you going to have to put in and when? And you want to reduce the surprises to the absolute minimum. You want to know on your spreadsheets, file by file. Do you remember we were talking about the expected completion date? So that is going to give you a month and a year in your spreadsheet. And all of those fee expectations go in. The work in progress valuation that you're going to pay out, that goes in as a minus. And then all the expenses of the firm on a month-to-month basis all go in. Then you put in the amount of money that you want to earn, so your drawings, that goes in. And that is going to give you a reasonable picture of what the finances of acquiring a law firm are going to look like. It sounds very simple when I put it like this, but it's actually quite difficult to get all the information, to get the right information, and very often the person selling you the firm doesn't want to give you the information at all. I was dealing with one sole practitioner who was very, very anxious to sell his firm, and I had somebody lined up to buy it from him, and it was a niche specialisation. So he just specialised in one single area, and he was very, very well known in that area. And all I wanted to do to kick the whole thing off was I wanted a list of his current files. A year later, I still didn't have the list of the current files. And it occurred to me he had no current files. So he didn't actually have a practice to sell. But he used to get his files, you know, maybe 2 a month. And then he'd work those files. He'd earn a reasonable amount of money from those files. And that worked very, very well for him. But that was never going to work for anybody acquiring his firm. So he got very annoyed with me and obviously never managed to sell his law firm. So understanding our cash flow requirements, that's back to your spreadsheet. Then you have to have a look at taxation issues and structuring how you might make an offer. Practicing certificates, the cost of those can be quite high, and it hits you in a very bad month in January. So January in your spreadsheet calculations is often going to look pretty bad, and that's going to follow November when you've just paid out your PI insurance. So these are expected expenses, but still very difficult to cover.
I just wanted to thank the Law Society for having this event and of course for inviting me to speak at it. David Connolly, who's my colleague, was meant to present, but he had to pull out at the last minute. Bank of Ireland and the Law Society have a long-standing relationship. It's mutually beneficial. Well, it is for the bank anyway. I'd like to think it is for them too. And through this long-standing relationship, we've created a number of products specifically for the law profession. Just to very briefly touch base on them, because Anne and Conor both touched on it. We have 3 types of short-term facilities. One is a tax loan, one is professional indemnity, and one is the practising certs. These are generally 11 months, and they can really aid with the cash flow of new practices, new firms starting out. We also have a student loan for any of your employees that are looking to complete the professional practice courses. These loans can be taken out through Smithfield College Green branch, and that was put in place in late 2017. Bank of Ireland are the largest lender into the SME market in Ireland, but outside of our lending, we do have a full range of products and services that can help when you're setting up. It's a full-service bank that we can work on when you're setting up. If you're buying a practice, becoming a partner in it, it doesn't matter what it is. We can also help if you're looking at putting in, and this is probably a bit further down the road, just different services that will help retain staff. Like we do have kind of bank at work schemes where we'll actually send out employees to your firms to meet your staff on a quarterly basis so that they don't have to take their lunch break and come down to the bank if needs be. Today I'm actually going to discuss on how the bank actually analyse a credit application. I'm going to run through a few case studies as well. On our website you will find useful tools, so it's business plan, it's cash flow modelling that Anne has talked about as well, just to put these together. And you can actually apply for any of the facilities I talk about or any of the products through a number of different channels, through Relationship Manager, through any of our branches or through our online departments. So just looking at a credit application, and to be honest, Anne and both Conor have touched on an awful lot of this, so I will run through it. The firm structure is key to us. So it is the details. How many partners is there or will there be? If there's 2 or 3 partners, is it an even split in shareholding, or is one 75%, one 25%? And just what are the level of drawings from that partnership expected to be? We just look for bios then on the key people in the firm. So again, it's just a few bullet points. It's not an essay. Usually on the websites that you've created, you'll have all the experience put up there, and it could just be summarising that into a few bullet points. It's again mainly about the partners, but if there's somebody key in the business, be it the former partner, the former practice owner that stayed on as consultant, he'd be key to the business for 2 or 3 years. Just a few points on him. There might be a financial officer in there that's helping you. Just a few points on them. The next one is just kind of the commercial rationale for the transaction. This is really self-evident. If you're looking for a 250,000 loan to buy a practice, that's the rationale. You're looking for 250,000 to buy the practice. It's that simple, but you have to set it out. It might be it's 250 to buy the practice. It might be 50,000 to upgrade the software, and it might be 50,000 for your insurance. It's just setting it out in bullet points so that you know exactly what you're looking for and what finance best suits you. The competitive dynamics of the sector. So again, it's the professional sector, but within that you might be more heavily related to litigation or to conveyancing, and it's the competitors in the areas of the sector that you are actually focusing on targeting. Again, just a few of the main competitors you see in your area and what differentiates yourselves. The next 3, past financials, projections, management accounts, and aged debtors and creditor listers. So debtors is your work in progress. These are all packaged into one, so it's looking at how the business has done historically, what will happen going forward, and again, the aged debtor list, it really is, if there's one key debtor in there that's making up 50% of your turnover, that's a risk, and it has to be addressed. How reliant is it? This one is the hardest document to get from any solicitor. We don't need it in all cases, but in some we do insist on it. Again, depends on the size of the firm. The creditor listing is, so this is people that you're paying out. So this helps us, the debtor and the creditor listings, helps us understand, in quite short, what your working cash flow cycle like. So if it takes you 90 days to get paid from a debtor and you have to pay out within, your creditors within 30 days, there's a gap there of 60 days that needs to be funded. That could be by overdraft, it could be by putting in the tax loans or those facilities that help smooth out your outgoings. But it's good to understand it, and Anne probably will agree with me. It's just one of the key things. Cash flow is the key thing for any new firm starting out. The past financials, again, depends on what stage the practice is. If you're buying a practice or if you're setting up on your own, you won't have. If you're setting up on your own, you won't have past financials. But it's to have a good idea of where the business was and where it's going. The next is if you're buying an existing practice, it might have existing facilities and you're just coming in as a partner, or you're coming in to take it over. So they might have term debt there, they might have overdrafts in place, and it's just to have an understanding on it so we can calculate repayment capacity, and then just a statement of affairs on the principals. So just running two case studies. They're both quite similar, and it is really two small firms merging, Firm A buying Firm B. So again, we look at the financials, the historics, and we try and extrapolate what the net profit before distributions is. Then we take off that the solicitors have to take a drawing out of it. They might have some CapEx spend, which is spend on your IT products or the building itself over depreciation. So what's the excess of that? And that gives me free cash flow. Say in Firm A it's 90,000, and in Firm B, which is one solicitor, it's 80,000. So my combined free cash flow is 170. So it's been agreed that the purchase price in this deal is 450,000. There might be deferred consideration of 100,000 that's due in, say, 3 years' time, and partner B is going to stay on for that 3 years, and Firm A is putting in 100,000. So the debt required is 250. So in this case, we'd probably look at a 3-year facility. The loan repayments, I'm basing this on 5%. Every deal is specific, but just working on 5% on this basis, the loan repayments would be approximately 90,000 per annum. There's 170,000 of free cash, so it's debt service cover of 1.9 times. I have kind of just run another model. It's not here. So obviously, if solicitor from Firm B is joining as a partner, his drawings are only 75,000, and the other two partners are on 100,000. So his first conversation might be, well, my drawings are going to be 100,000 as well, to marry it all up. So it's the same thing. Your free cash flow is going to drop from 170 to 145,000. Your loan repayments are 90, and your debt service cover falls to 1.6 times. Generally speaking, banks will look at debt service cover in this scenario to be somewhere between 1.25 and 1.5 times. So there's a bit of scope if there was higher spend or a higher loan amount required. The deferred consideration of the 100,000, which has to be dealt with in 3 years' time, there's a couple of scenarios with that. Obviously, the firm will hopefully have built up the excess between the loan repayments and the free cash flow, so they can just write a cheque and pay it. But they may not, so they may have to come back into the bank for a top-up facility of 100,000. But obviously, they've just repaid 250,000 over 3 years, so provide another 100,000. There's a history built up. Generally speaking, we'd look at the same model again, but it would be fine. Case study 2 is again, it's the same metrics that I've used. It's Firm C is 4 partners, Firm D is 3 partners. The only difference in this one is there is a building. So we're saying that Firm C actually has a property available to offer to the bank as collateral. So again, we just calculate what the free cash flow is historically. We work out that they're only putting in 200,000 of their own input. There's no deferred consideration, but they're looking for 2 million. Now, depending on the value of the property, this is close to a 90% loan to value. It would be at the upper end of the spectrum for the banks. But because there's a property, we can look at a 7-year term loan with a 15-year amortisation. There is a risk there for you that at the end of the 7 years, the bank may not renew the facility, and you may have to go elsewhere. But generally speaking, if everything is happening as it's meant to, the bank will just extend that 7-year term when it's coming to maturity. Our security package in this scenario would be we take a charge over the property, and we might look for life assurance on the partners just in case of event of death. So you work it all back out. The free cash flow is 390, the loan repayments are 190 over the 15 years, and the debt service cover is 2.1. This is always looking at the historical accounts. So this is easy. This is bread and butter stuff. It's reading a set of accounts. In practice, what you have to do is work through what the management figures and projections are going to be. Factor in that there is going to be cost savings by the two firms merging. So there might be a reduction in admin staff. There might be synergies between the work in progress that's available. So there might be cross-selling into new clients. And just generally the firm getting bigger might be able to attract more work in progress. And that's where looking at the 3-year projections and seeing how realistic they are and what assumptions were made in assessing that might help us get to those figures. So you may not have the historical figures showing free cash flow at 390, it might only show 300, but the other 90,000 is built into the clear assumptions. So what does the bank offer if they're admitting a new partner? So this is a new partner coming into a firm. So it might be somebody just been brought up through a salary partner into equity partner, or an equity partner coming in. So generally speaking, we'd look at lending to the partner directly. It's a non-secured loan. Depending on the size of the loan, we may need an undertaking from the firm that in the event of the partner leaving, the bank will be paid before any distributions of their profit. And this is just for their capital account more than anything else. We take life assurance on the partner and we make sure that they can be amortised over 5 years. So we'd look at the partner's income, the partner's expenses, so his mortgage, any other loan payments he has, and can he service that debt over 5 years. And we'd factor in that if he did leave the firm, or if anything did happen to him, the firm pays us back our capital, and whatever's left in his capital account is paid out to him at that point in time. This is, again, just it's really kind of for medium to larger firms, but it is something that we're looking at more and more. People have to start out, and it's one of the only ways they can do it is through a personal loan if the firm can't contribute on day one. The final thing is what can Bank of Ireland do for solicitors? So as I said, we're the full service bank. So the way I look at it is we're for the partners, the employees, and for the firm itself. So a lot of this is clear. It's current accounts, so we have the business and personal accounts. We have an online payment system for instant receipt of funds. You may be aware or may not be aware, but Bank of Ireland is currently spending $1 billion at present on our IT system. It's very much needed if you've ever used it, but it has been done in the background and started about 2 years ago. And the next 2 or 3 years, we will see the rollout of that, probably through personal first and then into the business. We have the deposit product offerings. Again, there's very little, if no interest rates been paid at the moment, but again, hopefully over time that will come back. We do the personal and business loans again. It's mortgages, overdraft, term loans, credit cards, and I'll touch base on what kind of working capital facilities are available for the business in a second. Coming down the road in the next couple of years will be pensions. Again, we offer this and life assurance. The pensions is probably 2021 where we'll really see some movement there if it becomes compulsory that employers have to have a pension scheme and contribute for their employees. As the firm grows, it is a really good way of retaining staff, as is the life assurance benefit for staff, so death in service or critical illness. The working capital facilities then for the firm. Overdraft, annual PI facilities, annual tax facilities, and professional certificates. They're 11-month facilities. It really is. It just spreads the risk across. You can borrow, generally speaking, up to 100% of what the cost of it is, and they just grow over time as the PI cover increases. The facility can increase. From a repayment capacity point of view, they're an expense in your accounts anyway. So it really is just the interest is the extra bit that has to be funded.
Good afternoon, everybody. My name's Hilary Hayden. You've listened to the solicitors, you've listened to the bankers, I'm afraid you've got to listen to the accountant now. So if anybody wants to leave, I'll understand it, but I prefer you to stay. I set up our practice in 1990, and we have 3 partners at this stage. During that period, we've carried out quite a few acquisitions, we'd always call them acquisition mergers because they always get marketed as a merger when you've bought a practice. So we've got quite a bit of experience in doing it within the accountancy side of things. One of the practices that we bought was one of Charlie Russell, and Charlie was a specialist in looking after law firms. And as a firm, we were looking after quite a lot of professional services, and this was a niche that we saw as something we'd want to get into. So, hence, we did. Now, oddly enough, and again, I suppose I'll tell the story very quickly because I met Charlie, I think, at a golf outing in Ross's Point, and he said, "I'm thinking of retiring." And I said, "Charlie, don't be so stupid. You're a young man at this stage." I think he was 60. "What are you thinking about?" And he said, and I didn't believe him. We were playing against the English Chartered Accountants over in Jersey about 6 months later, and we'd just finished our game of golf, we'd won our match, and he says, "I think I have that deal done, Hilary." And I said, "Oh my God," I said, "we better go for a walk." So we went for a walk along the beach in Jersey and we shook hands at the end of it, and we actually have stayed friends to this date. So it is possible to do a good transaction. I wish all the other acquisition mergers that we did were quite as successful, but we might go into more of that at another time. But you learn. It's maybe sometimes it's not do as I do. It's maybe better do as I say because. But we've learned, and I think anybody that's been through any acquisitions or mergers or anything else, you learn every time that you've done it, and it's a very important side to it. So you've decided. I mean, and again, in terms of Anne and Conor and everybody else that has spoken, I mean, we will cover common ground, and I'll try not to be covering it, or I'll cover it differently if I can. But you've decided to buy a legal practice or to buy into a partnership. That's the first decision. They are distinctly different, but there are commonalities in terms of what I'll cover because I'm going to cover fundamentally the due diligence aspects of it in terms of what you do. So the first question you'd ask yourself is why would you buy a legal practice? For many people, it's to get started in practice, and that's how a lot of people do it. Or alternatively, is to expand an existing practice. I started off with no clients. Maybe not such a clever idea, and certainly I would look at people and say the opportunity to set up in practice by buying over a practice makes a lot more sense because you're actually buying into a critical mass. The driving forces, as I say, are to get a head start in a new practice setup. If you're acquiring a practice that, having carried out your due diligence, has got a recurring fee income of 200,000, well, then you know what you're starting with. It's a lot easier to talk to Bank of Ireland about banking it and putting together the business plan because you've actually done all the homework that's necessary in there. Other reasons behind acquisition can vary from trying to improve the firm's competitive position. So to actually, if you do have a niche market already and you have another practice out there that has another niche market and the two of you get together, that could be another reason behind an acquisition. Specialisation, because there's a legal practice out there that has a particular, the sole practitioner is particularly good in an area that you're weak in, that's another reason for bringing in it. Again, geographic locations, it makes sense. If you're in Dublin and you want to have a Cork practice, do you set up from start or do you try and find a Cork law firm that you can actually acquire because that's what you want, or Limerick or Galway or any other location, etc. To increase your client base or to improve or solidify client relationships, and that could again come around because you've got a niche. Ultimately, the primary motive, and this is the accountant talking, I'm afraid, again, is to why you would actually want to acquire a practice is to increase your profitability. It's not really a dirty word, it's to make money. That's the fundamental of what you're actually trying to do out of it. And I think that should be a cornerstone of what you actually look at in terms of what you're doing. So, I mean, trying to find out information. I mean, if I turned around and said to you that I've got 2 envelopes here, and would anybody give me €100 for either of these 2 envelopes? I don't think I'm going to have too many takers. Why? Because you don't know what's in the envelope. So it becomes very important when you're actually looking at a practice that you want to acquire to look inside the envelope and try and find out what exactly are you looking to acquire. When you look at acquiring a house, you don't just look up the Irish Times or the property pages. You pick out a house and you ring your solicitor and say, I'm buying that. You carry out due diligence. You go and have a look at the house. You go through it. You get a surveyor. You get everything else. And the same actually principles have to apply to when you're actually looking at buying a legal practice. So we'll take a closer look at these two envelopes that we have here. I better hold them the right way around because we've got A and B or A and B. So now we're actually going to get down into a little bit of the substance and try and give us a little bit more awareness of what exactly we might be buying. And again, Anne is right, because the seller frequently is they're very coy at telling you what they're actually selling, right? It is a bit like looking inside an envelope sometimes. So, but what we've got here is we've got two practices. We've got practice A with a fee income of 500,000 and a net profit of 300, and practice B with same turnover but a profit of 200. So I guess we can all probably wrap up and say we'll buy practice A because it is 300,000 profit, and it probably makes sense because that's the way it looks. But the reason why we actually have to carry out due diligence is because we want to look inside that. We want to test that. We want to check whether or not what we're being told on the front page is exactly what we're getting. I mean, are we going to judge the book by its cover, or are we actually going to get inside and read the pages and find out what's happening? So we must establish what is the true value. I mean, one of the phrases that when you're buying is you don't mind paying for what you're getting as long as you're getting what you're paying for. And in order to do that, you must actually investigate the legal practice and see what's inside the business, so you can ascertain what is the true value of the business, and weigh up all the pros and cons. You may actually end up paying. You know, there are circumstances where you'll end up paying higher than the market value for a business, but that's because you've made that decision. If you decide to pay a premium, that's your choice, but you need to know what is the value of the business you're going to buy. So when you're looking at it, what you need to do is to try and establish exactly what is being sold. Goodwill, if you're buying the practice, and I'm not getting it, I'm dealing with you're buying the practice and you're not getting into, you are succeeding, you are taking over the business in terms of what's there. There are many advisors that will say that goodwill is worth nothing. It's not true. It's certainly been very low in recent years within legal practices, and it has been virtually zero or almost zero. But I mean, I had a solicitor in with me the other day who, when we talked about it, he turned around and said, but there must be some value for the 41 years of practice that I've had out there. And if you sit back and analyse that, there must be. But there's a question, and that's part of the challenge for the seller in that instance, is being in a position to present that 41 years in a manner that there is value in there, or that a purchaser will perceive value and can gain value out of it. But there are other aspects, so we've got to look at the legal practice and we've got to do a business valuation. Other aspects that we'll look into is the balance sheet considerations. Now, that's accountancy talk, but what we mean by that is looking and seeing, well, what other aspects of the business are we actually buying? And to some extent that covers, if we're just buying over the block of clients and we're not buying all the filing cabinets and we're not buying the staff and we're not buying any of these things and we're just purely, they're all balance sheet considerations. On the other hand, if we're buying over the practice and we're taking over the work in progress and we're taking over the premises, we have to look at those too. Again, and Conor, you alluded to this earlier, and it's a vital, important part of any part of the advices we give to people is your personal due diligence, and more on that. So when we come back to goodwill, there are two types of goodwill that are frequently there, and you have to again stop even from an advisor point of view and dwell on these for a minute, because there's personal goodwill and practice goodwill. Now, if you take the latter, practice goodwill is one that they're both intangible, but is a little bit more tangible insofar as that it's associated primarily with the firm, with its clients, the staff, and the recurring income. So you can actually get that feeling for it. The personal goodwill is the personal goodwill that's associated with the individual practitioner or partners involved. So if they're not coming with the firm that you're buying, then what you've got to assess and you've got to look at when you're looking at goodwill is how much of that goodwill is going to be lost because we've lost the personality. You could also look at how much you might gain more because you've lost the personality. So it can work both ways, right? But some of these are also very vital, important sides to it, because again, we frequently get the situation that comes at us where somebody wants to retire, they want to take a solicitor in, they want the solicitor to buy the practice, and the retiring solicitor wants to be a consultant for the next 5 years and wants to be paid $50,000 a year. And I'm afraid the first thing we have to look at and say, well, what's he going to do for that? What's the return? What's going to happen for it? And are we going to get a transfer of personal goodwill or not? And what will happen with it? Okay. So once we start getting into the brass tacks, and Anne covered this area, but so there is going to be some areas that we both cover because it makes sense. It's exactly what we both do, is that you look at the last 3 to 5 years financial. The last 3 are you put your biggest weighting on the last 3 because that's more recent, but you're also taking the last 5 years into account. Why? Because the times that we've lived in. You want to see where the practice has come, particularly through the recessionary period that we've had, and understand the business and understand the peaks and the troughs. You're trying to look at what level of profitability is sustainable going forward. There's work we've got to do in terms of eliminating non-recurring fee income and eliminating non-recurring expenses. What do we mean by that? Well, they're kind of self-explanatory. If there's fee income in there, and again, Anne covered it, let's say we've got a practice that doesn't do litigation, but it's had one litigation case in the last 10 years, and this year it's got a fee income of 40,000 coming in from that. Well, that's not recurring fee income. That's windfall, and we need to look at it. So we're looking for that. We're also looking for not just the expenses that are there. Same thing, just said differently, missing expenses, what's not in there. So if we go into the fee income side of things and we try and give you a better view of the areas that we will look into, we want to break down the fee income into its key areas, right? So we'll look, again, predominantly more over the last 3 years with this, but we're breaking it down into how much is litigation, how much is probate, how much is coming through from conveyancing, how much is coming through from PI, etc. We'll look at the number and the type of clients. We'll identify key clients, and to try, again, key clients, if they're going to stay with the practice that you're buying, are going to be in a situation where you've got a better confidence of recurring business coming through from key clients. There's a lot of practices out there. For example, if you're dealing with a practice that has fundamentally PI insurance, if they have a number of clients that are coming back every 1 or 2 years, well, then you've got to worry, because if they're putting through PI claims that often, you're going to have a problem, right? So it depends on the type of business, and it depends on the type of client that's recurring, and that's what you're looking at. You're looking at the historical growth. Again, and I don't disagree with Anne, we look at a will safe, but how many, and more importantly, how old. I mean, I've one that we're dealing with at the moment where it's 3,000, but I think some of the people are probably about 100 years dead already, but they still have still 3,000 wills there, you know. So you're looking at annual, recurring and non-recurring fees. What you're trying to do is to establish exactly for the bank, exactly for the people, for you, the solicitor who's actually going to buy it, for everybody that's party to this acquisition and is going to go through the pain and trying to make this successful, is you're trying to establish what level of recurring fees are going to happen. Transferability of client relationships is one not to forget, because frequently there can be leakage, and there can be reasons why the leakage is there. So you've got to actually look, and that comes back to really looking at the key clients. Clients and referral sources are also important, because if, for example, you have a practice that has a debt collection service and they have a particular relationship with maybe 6 credit unions, etc., that's great, very good repeat business that's coming through. But you've got to then go and look and make sure that you've got the transferability of that. So if we go back to our 2 Practice A and Practice Bs, we begin to see that the picture is emerging that little bit differently between these 2 practices, because we're getting under the bonnet and we're beginning to see that they're very different in terms of the style of business that they're doing. Practice A does a lot of conveyancing, low profit, but there's quite a big margin in there. They've got quite a few builders that are clients that they get a lot of referral work coming through from. They've got quite a good probate business, a good wills cabinet, family law is low, employment law, personal injury. I think this is the one that they've only got one litigation case in the last 5 years, so they don't do much litigation. Big debt collection, and they do a lot of business law, because they have a relationship through, I think it's a brother of one of the solicitors, wherever the relationship is, because this is all fictitious. But he's able to refer business through, and it's coming through on the buying and selling. I think in this case it might be pharmacies or something like that, so it doesn't matter. We then get into Practice B, and you can see very quickly it jumps out. It's a big PI and litigation. It's where it is, but they're specialists at it, and they do a very good job. And we'll have a look. So we're getting a feel for the type of business that's in there, right? Clearly, we've got to establish and go through all of those from a monthly point of view. Okay, so having carried out that, we then go into, and again, we're covering common ground, but we're looking at the staff and the employment side of things. If you're buying a practice, and again, it was touched on by the other speakers, it's a very, I suppose, I actually think 2-pay applies a lot more than people think, and people manage to persuade themselves that it doesn't, and I think get away with it rather than anything else. Now, I'm not a solicitor, so I'm not in a position to advise on it, but I have cases at the moment, one where we have a split situation where a few partners believe that it doesn't apply and other partners do, and they're all solicitors, and nobody can actually agree whether it does or it doesn't. But it does need to be considered, and if it's there. Now, it's not the end of the world if 2-pay is there, because what you're actually doing, and a critical thing, are employees an asset or a liability? That's part of your due diligence. That's part of what you're actually wanting to try and assess when you're going in there. And it may mean talking to some of the key staff as well. So what you want to get a breakdown of who the staff are, what do they do. You want to review their employment contracts, if there are any. If there isn't, you want to get an idea of their current salary, period of service, etc. When are their review periods? What are the implications? Have they performance bonuses? So you've got to go through the numbers side of it. But then probably most important of all, you have to consider the qualifications and proposed role for staff members post-acquisition. Do you have a job for all of these people, and is there a role for them going forward? In most cases, the answer is yes, but there will be examples where you actually have to turn around, and to make somebody redundant because they're not required under a 2-pay, it can be achieved. But you do have to look at it, and you have to look at the costs. Yes, if you're taking everybody over under 2-pay, you're taking over all of their redundancy, entitlements, etc. So you've got to factor that in, but it goes in under the contingent cost liabilities because it's not something that you hope to be paying out. The reason for turning around and taking over and assessing the staff is to make sure that you're happy to take these people, that they can play a role in your firm going forward, and that you're happy to have them on board. When we look at other elements of the due diligence, we look at the overhead expenses, and again, I'm not going to cover this slide too much now because it was covered earlier, but you're looking for non-recurring. There's some obvious ones that jump out, where the solicitor owns the property, and you're looking, and he's making a lovely big profit, but there's no rent in the accounts. And if you're going to take over that practice, you're going to have to factor in a rent. So you need to bring that into your due diligence, that there's a rent going to be payable for this, unless you're buying the property as well. But buying the property as well changes, in a lot of circumstances, the dynamics of what you're trying to do. And again, it depends from case to case and circumstance to circumstance, but frequently if you're buying a property, it increases considerably the cost of acquisition depending on location and value. You check for adequacy of overhead costs, insurance cover, not just PI cover. You're looking at that, but you're looking at that for a different reason and many other different reasons. But if it's excessive, is there a claim side of it? But you're also looking to make sure that the level of insurance cover is adequate on other areas, from public, employers, etc., profit liabilities, etc., and you're looking. Has the firm got adequate marketing costs? So you're looking at the adequacy of overheads. Again, missing costs that you're going to have to factor into your business plan and cash flows. It's a useful exercise to benchmark the overhead costs against other practices. Difficult one, but can be done in certain areas, which is possible. It's not possible in all aspects because property costs, etc., can be different. You do need to, and again, because you're going to ultimately, when you're finished doing your due diligence, it's going to find its way into your acquisition plan. So you need to consider what cost savings and synergies and benefits can be achieved through the acquisition. And again, an important part in here is that when you're assessing a practice and you're saying, right, we can buy this practice because we can add huge value to this practice because of what we do, right? But this gives us an opportunity to add value over and above what it has itself. That's a benefit, but it's not a benefit that you should be paying the practitioner for. That's what you're bringing to the table, and it should be something that you mark for for your own development and for your own business plan side of it, but it's not something that you factor into when you're assessing the value and the potential cost of what you're going to buy. You've got the legal and business side of things, and again, a lot of these things are common sense, practical, but trust me, I've seen too many situations out there where people really don't look at them, that they're caught like rabbit in headlights because they want to get a deal done, and it really is so important to actually go through everything. You look at an office property where it's leased, you need to look at the fundamentals. And I'm not just talking about from a legal point of view, I'm talking about from accounting and financial due diligence point of view. When's the next break clause? When's the rent review? Is it overcost? Is there a potential for a decrease in the rent because there's been too much paid? You have to look at all the different, and basically with each one of these areas you're looking to see, is there a cost? Do I factor in the cost? Is there an opportunity? Is there a saving? And each one of them you're looking at all and then deciding which column you can actually put it into. If there's a saving, you're not putting it into the column that you're valuing the practice at. I mean, each one of those areas, from looking at the equipment, the obligations, the software license, the insurance policies, the claims record. Claims record is essential to look at because, I mean, if it's going to tell you a lot about how a practice has been run if they've got a lot of claims. People can be unlucky, particularly the volume of claims that have gone up in the last 10 years. It's been dramatic because everybody's been blaming everybody else because it seems to have been an easy thing to do. So you have to factor in the circumstances and get in behind it and then decide whether or not this is this a reason to walk away from the practice, or can you live with the fact that there's a claims record? You're then going to have to assess what the potential implications are of taking this practice over for my insurance going forward in terms of where I might be and whether or not I could be hit with additional loadings in terms of where it is. Practice review management, you've got to look at, again, a lot of these things are to tell you about the practice itself. I mean, if a practice has been run manually, it's telling you where it's coming from. It's telling you the era, etc. So in some ways, it also tells you, it may tell you a little about the clients themselves as to, has everybody grown old together, for example, in a practice where somebody who set up in Dundrum in 1990 and is nearly 60 now and all his clients are older than him, and if you buy this practice, are you buying actually something that's already sinking? Is that what's happening? So there, I mean, you've got to look at those. It's very difficult, some of that, because you can't actually go and ask every client of the practice what their age is, but you just carry out the work and carry out as much of the due diligence as you can. It is certainly, if they've got some key clients, it's worth talking to them, because if they've got key clients, the likelihood is that the solicitor has told them, I'm getting ready to retire and I may be something. And he's going to have to tell them, so it's as good a time as any for you to meet somebody and get your own feel for what they are like. But again, website, marketing literature, not every practice is an old practice, so just remember, there are practices out there that can be acquired that are new practices that have very good websites, etc. So you've got to factor all this in. It isn't all about the old fuddy-duddy. There are reasons for acquiring practices that are strong and vibrant, and the same due diligence considerations are required. So at the end there, consider all risks, the culture shock for clients, staff, the competition, the location. They're all important things. I mean, I remember one of the practices that we looked at, and it was in Balbriggan, and there were two partners, and what we didn't find out until much later was that they were really fighting with each other, and that's why they were selling, right? So that wasn't a great help to find, but neither of them told you this. But when we had signed heads of agreement, we went off onto the beach in Balbriggan to take a photograph. And we certainly then knew that there was going to be problems when one of them wouldn't come out for the photograph, right? So culture shock can change things, but as to what you're actually looking at. So thankfully we got out of that fairly quickly. I've kept this one very short because I don't like telling solicitors all about accounting things like balance sheets, but it is important. I mean, look, when you're taking over a practice, there are assets that you might be acquiring. It might be the filing cabinets, it might be the office furniture, it might be the server, it might be other pieces of equipment and everything else. You do need to, you need to take a look at and check what's the market value, what's the book value, what's the tax value. You've got to, it's part of the exercise. Now, obviously, you don't necessarily, I'm not suggesting that you have to do all this yourselves. We'll come back to that. The work in progress is essential, and Anne covered it very well in terms of getting a schedule of the assignments, trying to confirm the valuation and the recoverability. Back to, you don't mind paying for what you're getting if you get what you're paying for. So if you're taking over files and there's work in progress built up on them, fair enough. But you have to know that in delivering closure to those files, that you will be able to make a profit and not lose. So you do have to get into a very hefty assessment of what value you're going to actually achieve out of that yourselves, because the current value may well have to be discounted depending on the nature of the assignment and the nature of the file. If you end up, and it can happen, there's reasons why everything can happen because of tax planning. You could end up taking over the debtors, you could end up taking over creditors, but if you do, you've got to watch for what are you taking over. You've got to make sure that you've actually checked that there are no bad debts or sufficient bad debt provisions, and you consider all other contingent liabilities. A lot of things, but I mean, any of us, like Anne and myself, that's doing this work, I suppose it's like being a surgeon. You're used to doing it, so you know the things that you're actually looking for, and it comes second nature. But we don't second change on any aspect of them as to what we're looking at. Let me see, where am I? Yeah, we'll go to here. Yeah, I just wanted to put in, because we're covering the buying of into a partnership rather than and there's, I suppose, the extra pieces of due diligence that you have to look at there is, you need to understand the profile and role of existing partners. You've got to be comfortable that in going into a partnership that you're going to be able to work with these people. So, you've got to assess the capital contribution on entry. Is it fair value? So you're going to have to do all this work that we've just talked about. There's a lot of similarities, but there's a couple of issues that are in there that are very distinct. And you've got to make sure that you've covered the areas like the allocation of profits, the percentage of ownership, who combined the partnership, the decision-making forum, death, retirement of a partner. Again, a key one, and dealt with, is resolving disputes, because if there's no mechanism for resolving them, it could end up down in the High Court. Thankfully, most of them end up in mediation stroke arbitration, but mostly mediation, which is why we don't hear about them. But that doesn't mean that it's not possible for it to end up there. It certainly gets threatened to the High Court on more than one occasion. And ultimately then, no matter what you're doing, in looking into buying into a partnership, the partnership agreement, and which you're going to be bound by, you need to be happy. You may not be able to change it, because if there's existing partners in there and they've all agreed to it, you may not. But if you're not able to live with it, then this mightn't be one for you. Okay. So if we go back to our two practices, and I'll try and cover this, but just to give you the example, and in the case studies that we've looked at, is when we look at practice A. We talked about the fact that it had windfall litigation fees of 42,000. It had the solicitor owned the property, so he wasn't charging any rent, so that's why we have 42,000. And he had depreciation on his equipment of 6, because we'll add that back when we're assessing what we look at is a word called maintainable EBITDA. It's the cash really driven by the business. So I don't need to, let's call it cash, it's probably easier, but we have to live with the technical terms sometimes. So when we look at that and we adjust it, we come up with an adjusted profit of 224. When we carried out our due diligence on practice B, they had actually got an exceptional bad debt of 33,000. We looked and said, actually, all the bad debts here were 38, that the provision of 5 was standard because you will have bad debts in the business, but the 33 was exceptional and related to prior years, so it wasn't fair to penalise the year that we were looking at. There was a redundancy payment as well that was in there that came about for something that happened and shouldn't have, but it did. There was a spouse's salary charge in the accounts, and we established that the spouse did no work there. It was just purely for tax planning. There was a loan the Bank of Ireland had kindly given them, and the loan interest on that of 17,000 had to be added back. So when we went and we're now looking closer to the financial aspects of our due diligence here, we look at that practice A, which looked like the nicer practice to buy with a profit of 300,000, versus practice B, when we actually look, it's adjusted profit, and we look at it, practice B is now much more profitable. It's 317. If we take out a solicitor's salary, which we generally would because we're looking at whether we call that drawings or is what you're going to get out of it, because you're still going to have to work to make that happen. We come up with a maintainable EBITDA or cleared profit for that business of 124 for practice A and 217. So in this circumstance, we're looking at it, and now what looked like two very, in fee terms, very similar practices. One was more profitable than the other, yet when we went and carried out our due diligence, the second one actually it flipped, and the other one. It can happen. It's to just give you an example of the importance of looking at each area and give it to you in broad terms. The personal due diligence side of things is probably, I don't think you should ever underestimate the personal element of looking at any acquisition or any transaction to buy. Whether you're trying to set up and buy into a sole practitioner's business, or you're trying to buy into a partnership, probably at all very much those sort of circumstances, you've got to be satisfied that you've got the skill set required to manage the legal practice. In other words, you've got to be confident that you can make this happen. There's no reason not to, but I've come across many situations, not so much with legal, but with other professionals where I've got pharmacists who might have bought a pharmacy, and they look at all their friends who have bought 2 and 3 and 4 during a period, and they come along and say, well, I want to buy a second one. And you sit down and say, well, have you got the capacity to run a second one? Because in that instance, it's a retail, and one pharmacy is very important. The pharmacist is very critical to the pharmacy. And I had one situation where I said, I don't think you should. And he said, no, I want to. So we bought it for him, and 3 weeks later he came and said, can you sell this for me? I can't handle it. And it only took 3 weeks for him to realise it. So you've got to know that you have, and you're comfortable, you have the financial resources available to complete the acquisition and the integration costs, because it's not just, if you end up paying 100,000 to acquire a practice, but there may be another 25,000 of integration costs, and we would be looking at the working capital, which you could include in integration. You need to be able to cover both those, because if you go to Bank of Ireland and you borrow you borrow sufficient to be able to complete the deal, and then within the first 12 months you're running into working capital problems, therefore cash flow problems, therefore banking problems, it doesn't work because you're on a wrong foot. Now you've got stress and everything else. So that's why it's important not to actually try and make sure that you plan yourself very, very carefully in these transactions. And again, critical, confident that you can balance the business demands with the family essentials. Now, I'm probably a bad case because I still work about 12 hours a day, but because I enjoy it. But do you live to work or do you work to live, I think is the phrase that's used most oftenly. And for many people, they work to live, and it's a good way, and it's certainly the way that the generations, my kids are certainly looking at that far more, and it's a good way to be, I think, because life goes so quickly, so you need to make sure that you enjoy every bit of it that's out there. But you must balance that, because when you go to become your own boss, particularly where you're going to become acquire another practitioner, you need to be able to know that there is a lot of hard work. So you've got to look at, location becomes important, everything becomes important, because your time management becomes very important. So I would urge that you actually sit down and establish goals and objectives as part of your process, and they should be business one and personal ones. And they're perfectly valid. If you want to have 3 weeks holidays out of the country every year, build that into your plan and make sure that you make it happen. If you want to play golf every Wednesday afternoon because that's what you're going to do, build it into your plan because that's what you want to make happen. And then try and see how you gauge it. But you must have the plan to actually try and deal with it. And that is, probably, this page here is probably, I think, one of the most vital and important pages of all, because you have to, once you've done all your due diligence and you've established you want to actually buy this practice, and you've agreed a price, and you're ready to go, you must complete this page. You must prepare your plan. I would say a 5-year plan. We're not looking too far at years 4 and 5. We never are, because you can do something about the next 18 months, probably the following 18 months, and then years 4 and 5 are somewhat hope. But you should still have that, because you should be building your targets and goals for where you're going. But what the first 3 years does, and the first 12 months in particular does, it establishes what your working capital requirements are and how you need to fund those. And they're critical parts of actually planning your business. And you should revisit that, every year as to where you are and where you go, and to your goals and objectives. The legal agreement, I can't understate. Agree heads of terms and conditions and draft the acquisition agreement and partnership agreement, but don't do it yourself. Get independent legal and professional advice to do it, because to do anything else is just absolutely wrong. I've got another case at the moment where, with a partnership agreement signed between two partners, and one partner says it doesn't count, and the other partner says it does. Now, and they're two solicitors. And when we looked at the partnership agreement, in fairness, it was one that they've worked out themselves, and it was poorly drafted. So there are actually conflicts in it. So get somebody professional to do it, because what it does do, it makes you stand back and assess, what am I doing with a professional person, right? As to, have I ticked all the right boxes? Am I doing all the right things? And have somebody else do it. It's very important. Prepare a marketing plan. Again, another one of the critical ones, because there's a lot of things can happen within the practice that you're going to buy, because you might be specialising in conveyancing, and this practice has a lot of PI. So you've got to figure out how you're going to work this. That's part of your business plan, but it's also part of your marketing plan as to how you're going to market to get to your clients, how you're going to market to get to your customers, and how you're going to market the business and the profile of the business and everything with it. And it's so important. Client, staff, and third-party communications, again, critical, so that you're getting it right. And that's the same even if you're buying into a partnership, because you want the announcement to be right. You want it to be saying the right things. The same with how you communicate with clients, how you communicate with staff, and how you communicate with third parties. Examples, in any of the acquisitions that we've done to date, we've never called them an acquisition to a client. We've always marketed it as a merger, that we're taking in Joe Bloggs. I think I had Charlie on our headed note paper for about 12 years. The biggest row I had with Charlie was, when you talk about consultants, the whole deal nearly collapsed after Jersey, because I wanted Charlie to at least commit to 100 hours of consultancy. And Charlie said, "No, Hilary, when I give you the keys, I'm gone. I'm out of here." I said, "Okay, 50 hours." No. And eventually he agreed to do the 50 hours to get paid for them. But I never rang him and asked him to do 1 hour, and he didn't. I needed the comfort blanket. He didn't. We stood up on our own 2 feet and we made it happen. And again, but when you look at all these things, you've got to look at what's necessary. It's one I'm looking at on a couple of cases that I really worry about consultants. If they've got a role to play going forward, absolutely include them. And there's benefits from your own comfort blanket point of view of having them on your note paper. But don't be paying them for something that they're not doing. That becomes critical, and you need to establish that side to it. I've given it a little bit on tax planning here too, because we don't just advise on buying and selling legal practices, but we do the accounting reporting, and we do all of the tax and compliance work as well as a firm. There are important considerations, particularly if you're working for somebody at the moment and you're used to being paid and getting your pay slip every month, etc. Once you acquire somebody else's practice, you become a self-employed person for tax purposes, and that brings its own implications. You're no longer paying tax on a monthly basis. But don't worry about it. There's advisors that can help this stuff. You usually will set out an amount every month and put it in an account, and it'll be dealt with. This is one that, it depends whether you drop the contract yourself or not, but there is stamp duty payable on any contract to purchase the value of goodwill. That is the way revenue look at it, and that's the way that it is. Frequently transactions happen where people do it without exchanging documentation because they want to save stamp duty. So there is no document to stamp. But why would you do it? You need to protect yourself with a proper acquisition agreement, and therefore the additional cost of stamp duty on the goodwill element of a transaction is relatively small in the overall context of what you're actually doing. Another one to watch out for, just even on that, is if you are buying on a delayed consideration, For example, I mean, let's say the contract price is $500,000 and you're paying 200,000 up front and you're paying 100,000 after 1 year, 2 years and 3 years. The stamp duty is payable in that instance on the whole lot up front, even though you haven't paid over the other consideration, because it's a delayed consideration. It would only apply differently if it was a conditional consideration. Okay, so it was conditional on the fee income being X, and therefore it wasn't possible to actually ascertain that at the point in time of doing the transaction that the fee income was there. And look, there are small little things there, but the fixtures and fittings transfer at tax written down value. So if there are some and you've taken them over, you may well acquire those at their tax written down value and get some write-off for them. When you're going into a transaction to buy somebody else's practice, it's always vital to get inside their shoes, to get inside their head, and to try and understand what do they want and what does a seller actually want out of the transaction. You may not be able to deliver it because expectation and your assessment of reality may be too far apart, but it does become important. And one of the areas which is always useful to remember is that there is retirement relief available to a practitioner on the sale of a practice. So if you're under 55 to 66, it's 750,000 tax-free. Now, there's not that many sole practitioners that are being sold at those levels at the moment, but there are some that will reach those sizes because their value in their recurring profits are there. But there is another aspect to it, and this is something you've got to look at, and again I touched on it, is that if they sell if the property has been part of the practice and they sell the property, that also will avail of the retirement relief. But they don't actually have to sell the property to you. They can sell the property in the open market as part of retiring, but they must do it within the same, more or less the same time period, okay, as to what they're doing. So if that's what they're doing, then you're in a situation where you may be able to guide them in this sort of direction, because that may actually get you into a positive mood with the seller, and that might be helpful to their situation. But if that was happening, then you've got to tick the boxes, because you don't want them to turn around and sell the property and then you suddenly discover that you've bought a practice but you've nowhere to practice from, right? So again, it's important to get the lease in place before he sells it and agree that as part of your terms in terms of what you're looking at. So that, again, what I've said, and I keep saying, is that what you need are advisors. There are a number of us out there that specialise in these areas. It was President Lincoln who said, "He who represents himself has a fool for a client." I've seen variations of that where it's a solicitor who represents himself, but I'm sure you all know what I'm talking about. And we all do it, by the way, so let's not fool ourselves. Am I perfect in this? Absolutely not. But I think there's a point where it's a false saving that and you've got to watch, am I making a false saving by not employing somebody to do it? And have confidence in yourself that you'll get it back in what you're doing. I'm not from Cork, and I'm not a Manchester United fan, but I'm a great fan of Roy Keane's fail to prepare, prepare to fail. You're going out to buy a practice, you know, as I said earlier, you wouldn't buy a house without looking into it. Why buy a practice without carrying out all the due diligence? If the practitioner won't give you information about his work in progress files and everything else, maybe there's a reason, right? And I've come across these problems, the problems on accountancy practices, just as much as with legal practices. There's usually a problem behind all of this, and that's what you're looking at, you know. So we wish you all well with it, and thank you for bearing with me and listening to me. Thank you.